The second paper in this session will cover another very important topic, banking supervision. I'm joined on stage by Professor Shue from Yale University, who will present the paper. And our discussants are Professor Rafael Repullo from CEMFI and Claudia Buch, chair of the Supervisory Board of the ECB. Kelly, the floor is yours.
Well, thank you very much to the organizers for the opportunity to present and participate in this wonderful conference. Today I'll be presenting joint research with Sumit Agarwal, Bernardo Moret, and Amit Seru. The usual disclaimers from the US Fed applies. So our research is about weighted noise, and we'll be studying discretion in regulation. So our paper is motivated by this fact that reliance on human discretion is absolutely pervasive in institutional design. Judges, scientific reviewers, patent examiners, HR committees are all allowed to use substantial amounts of personal discretion when they make decisions. Now, human discretion has the benefit of allowing for the use of soft information. So that's real but difficult to quantify information that is open to interpretation. However, the downside of human discretion is that it can lead to quite noisy judgments. So noise we define as a disagreement across decision makers if they were to consider the same information. That means then that the same case with the same hard and soft information, if assigned to a different decision maker, could receive an entirely different outcome. So we're going to show that this noise leads to real distortions and increases the amount of uncertainty and volatility in the system. So specifically in this paper, we study bank examiners who are assessing the safety and soundness of banks, and we ask why these trained professionals disagree with each other so much. We model their final decision as a weighted sum of component level assessments across different issues, and we show that there are three main causes of this disagreement or noise. First, these examiners apply discretion to all components, even the relatively objective ones, such as their assessment of capital adequacy. Okay. Second, they attach extremely high weight to the most subjective issue. So specifically, we find that these bank examiners are assigning a 50% weight for their overall decision on just subjective assessments of the quality of management at these banks. And then finally, we show that there's a lot of heterogeneity across these examiners in how much they weight each particular component. That means then that even if they agree on every single issue, if they differ in their weights, they're going to differ in their overall decision. Okay. We then also explore the real effects of noise and also some of the benefits of allowing for this use of soft information. First, what we show is because there's so much heterogeneity across these examiners, we find that the majority of the time when banks receive a different rating than in their previous exam, that is due to differences in the assignment to a new examiner rather than differences in their true fundamental quality. Okay. Next, we show that this noise impacts real bank behavior. So when we look at exogenous changes in bank ratings due purely to a change in examiner assignment, that increase in ratings leads to substantial changes in bank capitalization and a reduction in loan growth. Okay? We also find evidence of anticipatory bank responses. So basically, because there's so much uncertainty and volatility that banks anticipate because they don't know which examiner they're going to be matched with, they adopt conservative actions in anticipation. Okay? We also show that discretion is not all bad. Okay? So these examiner decisions are not all noise. Discretion can be beneficial for making predictions through the usage of soft information. However, we show through various calibrations and simulations that placing moderate limits on the amount of discretion these bank examiners can exercise can translate both into more informative predictions of future bank outcomes while simultaneously reducing the amount of noise in the system. In terms of broader implications, I want to highlight this quote in an excellent book by Kahneman, Sabani, and Sunstein. What they argue is that if two felons who both should be sentenced to 5 years in prison receive sentences of 3 years and 7 years, justice has not on average been done. In noisy systems, errors do not cancel out, they add up. Okay? So what that means then, more broadly, is that even though we focus so much on random assignment really only guarantees fairness, okay? We don't necessarily want a world in which we have lots of random variation and lots of these great exogenous instruments that empiricists love to use, because what that implies then is that outcomes are randomly assigned to cases instead of well matched to kind of the merits of each particular case. Let me get to our setting and framework. We're looking at prudential supervision of US banks. This ends in the assignment of a composite CAMELS rating 1 through 5, where 5 is a failing rating. Okay. CAMELS is an acronym. It stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. The composite CAMELS rating has very important consequences for these banks. It affects their ability to do M&A, branching, access to the discount window, as well as government funding programs such as TARP. Okay. If these banks receive an unsatisfactory CAMELS rating, so that's 3 or higher, they typically react by dramatically increasing capitalization and reducing their lending. Okay. Now, in this setting, the examiners are given a lot of discretion in how to form this composite rating. So here's a quote from the St. Louis Fed. It says, "The composite rating is not an arithmetic average of the individual component ratings. Rather, some components are weighed more heavily than others based on examiner judgment of risk." So it's really up to the individual examiner how to weight these various issues. Now, our sample covers banks that are subject to regular examiner rotation. These banks are examined by state and federal agencies in alternating years and rotated across lead examiners within an agency region. So this allows us to make a random assignment assumption, which is that true bank quality, so both its hard information and the soft information that we don't observe, is uncorrelated with examiner identity within a region and time period. Empirically, we can support this assumption by showing that, at least for unobservable metrics of bank quality, those are uncorrelated with examiner assignment. Okay? Now, examiner discretion can impact the outcomes of both small and very large banks. Unfortunately, we do have to exclude the very large banks from our sample because they're not subject to examiner discretion, but certainly discretion could matter for them as well. Our sample does include some very large regional banks, for example, Silicon Valley Bank and other banks that failed in the recent 2023 banking crisis. Okay. So here's our framework. Let's suppose each case has some optimal outcome Z star that we may not observe, okay? Let Z be the actual decision, and we're going to say that's equal to Z star plus B plus E, okay? So here, B is a population level bias. Perhaps on average, bank examiners are too tough relative to the preference of the social planner, okay? E is going to be that additional error by individual decision makers. Okay? And the variance of E, which we're going to call sigma squared, that's the noise. Okay? So that's the extent to which examiners disagree with one another if they were to consider the same case. Okay? We're going to represent bank fundamentals by observable hard information, so that's X, as well as soft information, which is S. So soft information is not observable by us as econometricians. It's only accessible in this model through human discretion. Okay. So we're going to define discretion as the actual decision by these bank examiners minus the predicted decision conditional on hard information. So this means that discretion is equal to soft information plus the error component that contributes to individual noise. So this neatly decomposes discretion into two parts, good and bad. Okay? So the pro is that discretion allows for the use of soft information. The con is that discretion is going to now add individual noise. Okay? And now kind of the main trick of our empirical exercise is we rely on random assignment. That means then that decision makers see the same soft information in expectation, okay? What that means then, to the extent there's a predictable component in how much discretion one person is exercising than another, if they see the same soft information, that means we can isolate their individual error. All right, one last page of framework and I'll get to the results. We're going to model decision making as a weighted sum of decisions over component issue CL, where the decision makers can choose both the decisions over the issues as well as the weights, okay? This allows us to do a fairly standard variance decomposition, and we show that disagreement can arise from three sources, okay? So the first is, if these decision makers treat component issues as subjective, even the relatively objective ones, we're going to have higher disagreement, okay? Second, if they attach greater weight to the more subjective issues, then we're also going to have more disagreement, okay? And then finally, they could disagree in the weights themselves, okay? So this gives rise to the issue that even if we come to complete consensus over every single issue, if we disagree with one another on the weights, we're going to disagree on the final decision. And that disagreement further increases if we have greater disagreement in weights on the more subjective issues. Okay, so here's how we measure discretion. It's just the residual composite rating after conditioning on observable bank hard information. We have two measures of examiner level discretion. The first is examiner directional discretion. That's the average of the extent to which you differed from the predicted rating on all of your exams. This is a measure of the extent to which examiners are consistently more tough or lenient than other examiners within our sample. And again, random assignment implies that this is basically like an examiner fixed effect that can isolate the noise component. Okay. In some exercises, we also use the second measure of discretion, which we call absolute discretion. This is the average of the absolute value of my discretion across all the different exams that I've conducted. Okay? This is a measure of how much examiners deviate from the predicted rating in either direction. This is also an important discretion measure to consider because on average, I could have zero directional discretion in that I'm not more tough or lenient on average than other examiners, but I heavily weight case-specific soft information or my own gut feelings, which means I'm generally very unpredictable. Here's our distributions of what we find in terms of the heterogeneity and discretion across examiners. To put the magnitudes as an economic interpretation, what we do is we imply empirical Bayes shrinkage to our estimates of examiner fixed effects. This is because, of course, in finite samples, these fixed effects could differ from one another just due to finite sample noise. Okay? After we do that, we find that the standard deviation of examiner discretion across these examiners is 0.13. Okay? That really is quite large. So earlier research by Ahmed and others have shown that state agency examiners are more lenient than federal examiners. How much more lenient are they? By about 0.08. What we're finding is that the within agency variance in how lenient and tough examiners are, that variation actually exceeds the cross-agency difference. Okay? Another way to think about how much discretion there is in the sample is we look at the probability that a bank is going to get a higher or lower rating purely due to a change in examiner assignment rather than a change in its own quality. Okay? And what we find, I'll just summarize kind of the main takeaway here, the majority of cases in which banks receive a different rating than in the previous year, that's going to be due to a change in examiner assignment rather than change in the true quality of the bank and its either hard or soft information. Okay. Next, we look at why we disagreed, which has to do with weights. So for a small sample of examiners, we actually see simultaneous ratings for the same bank at the same point in time, so we can directly measure disagreement. Okay? And we find here the first source of disagreement is they disagree on the composite issues themselves, okay? So what we plot here is the fraction of observations for which two examiners give different composite or component ratings, okay? So all of these issues are treated as subjective, but the most disagreement occurs for the management rating, and the second most subjective rating is assets. The second reason why we have so much disagreement is that these examiners are placing very, very high weight on the most subjective rating, which is an assessment of management quality, okay? So when we try to estimate their weights, we're estimating nearly 50% of the weight across these 6 ratings is placed just on management quality, okay? So this high weight on management is consistent with the research in psychology showing that people place a lot of weight, perhaps too much weight, on face-to-face interactions. Okay? It's also consistent with the research on halo effects and affective spillovers, which shows that when people have kind of a general impression that something is off, okay, they tend to put that into the most subjective component of the assessment. Finally, we find a lot of heterogeneity in weights across individual examiners. Okay? So this standard deviation here is just for the management rating, how much we disagree with one another and how much weight we put on management. Okay? So because of this disagreement in weights, okay, one, we're going to disagree with each other even if we agree on all of these component ratings, okay? But further, we find the most disagreement for the most subjective issue on which there's already a lot of disagreement. So that's going to compound and add to disagreement, okay? We also trace out some of the real effects of all of this noise. Here we use a jackknife IV strategy. So basically, we're going to use the fact that if an examiner tended to be tough on her other exams, she'll tend to give a tougher than predicted rating on this exam, and we're going to trace out the causal impact of this exogenously higher rating, okay? And this is all due to noise rather than soft information here, okay? So what we find is that exogenously higher rating, so this is saying the bank is less healthy, that is associated with the bank taking pretty strong conservative actions in response, okay? We see that the bank gets a lower CAMELS rating, so that's a safer rating in the next exam. The bank increases its capitalization and experiences a full standard deviation decline in loan growth. Okay? We also find evidence of an anticipatory response, okay? So banks in states in which the examiners exercise more discretion, so they're exposed to more uncertainty about what their future rating is going to be, they ex ante adopt conservative actions by increasing their capitalization and reducing their loan growth. Okay? So this is similar to some of the macroeconomic uncertainty findings by Bloom and co-authors, in which firms reduce their investment in hiring due to macroeconomic uncertainty. Now, as policymakers, you might see this and say, that's great, we want banks to take more conservative actions, okay? But this is a different form of, let's say, uncertainty or opacity compared to opacity in stress tests. There, with stress tests and other tests by the regulator, banks don't know what the formula is, but the regulator can fully control the amount of uncertainty in the environment. Here, the regulator also does not have full control of what these supervisors are going to do. So it's uncertainty on both sides. Okay. And then finally, we look at whether there's an upside to discretion and whether there are ways to kind of improve upon the existing use of discretion. Okay. So again, discretion is equal to both soft information, which is great that we use it, plus individual noise, okay? And we asked, is there a way to make human ratings more predictive and less noisy? We face a measurement challenge, which is ratings both affect and predict future bank outcomes. Before, when I showed you that IV, we isolated the causal effect of noise. Okay? Here we want the overall predictive power of discretion, both the good stuff, the soft information, and the bad stuff, which is noise. Okay? So we're going to look at whether overall the discretionary component of ratings, that predicts outcomes that are unlikely to be affected by the ratings themselves, such as the future performance of loans that were already made before this rating is decided upon. Okay? And here's what we find. So we're going to look at the relation between examiner level discretion, separated into 3 buckets, whether the examiner exercises low, medium, or high discretion on other exams. And what we find is, in all cases, when the examiner gives a higher rating than predicted using hard information, that rating really does predict future bank outcomes in the direction that we would expect. Okay? So examiner discretion seems to be effectively using soft information. However, among examiners who exercise very high discretion compared to those that exercise a medium amount or a low amount, they are not necessarily offering better predictions. Here they're just introducing more noise. And then finally, we can compare actual ratings to machine-driven or constrained ratings in terms of their predictive power. Okay? And what we find is, if we were to re-weight these ratings, so we still allow human discretion, but we prevent these examiners from assigning a 50% weight to management, instead force that weight down, what we get overall is higher explanatory power for future bank measures of health as measured by AUC, okay, while simultaneously reducing noise. So I'm just out of time. Let me briefly conclude. What we're showing here is human discretion can be helpful. We actually reject some of the conclusions in the algorithm aversion literature, which has made a kind of a strong claim, in my opinion, that human discretion or human ability to predict outcomes is complete garbage. Okay? So there is some real signal here. But however, we point out that putting bounds on human discretion can be useful for predictive power, and especially because of the way that there's such a reliance on a weighting scheme. So if you were to put constraints on the weights, that can retain some of this predictive power while constraining the noise. And further, I think this highlights the importance of not just trying to come to consensus on individual issues, but having an explicit discussion about what are the appropriate weights on these various issues. Okay. All right, thank you very much. I look forward to my discussants' comments.
The first discussant is Rafael Repullo. Rafael, please.
Well, thanks very much. I'm very pleased to be here. It feels back home. This is a very nice paper, and on an area which deserves a lot more research. Now, this is about basically the role of hard and soft information in decision making. So hard information, basically think about accounting statements. Soft information is what comes from these supervisory assessments. Now, the outcome that is analyzed in the paper is this US CAMELS ratings, which is a number between 1 and 5. Now, what is important is the key in this paper is this exploiting these characteristics of bank supervisors in the US. They are rotated periodically across banks, and they exercise wide discretion. Now, the question is, what is this discretion doing? Well, I mean, the questions that the paper addresses is first, how can we measure discretion? The second is, does it matter for bank behavior, in particular from an ex post perspective in subsequent decisions on, say, capital and lending, and also ex ante in prior decisions on capital and lending. And finally, is examiner discretion good at predicting deterioration in performance, like, for example, in terms of non-performing loans and delinquency rates? Okay. Now, the institutional setting, I will be very brief. US banks undergo these examinations on a regular cycle, typically every 12 months. Excluding the largest banks, state and federal agencies are involved. Banks are rotated across examiners, and banks are rotated also across agencies in alternate years. There is concurrent exams by both agencies, and in which case they issue separate reports, and therefore we can measure disagreements in those cases. Now, this has already been said, the CAMELS 1 to 5, 5 is bad, 1 is very good. And they also have the benefit of exploiting each of the 6 components as well as the composite rating. Data, this comes from this wonderful database that covers 98 to 2020. They look at bank identity, lead examiner identity, and the exam date, and then they get all the ratings together with the components. They also use the call reports for computing, getting capital and leverage, returns on assets, non-performing and delinquency ratios. Now, the final sample contains 2,400 lead examiners and 14,000 examinations, so there is an average of 6 exams per lead examiner. And the distribution of the ratings is that 1 and 2 are the most frequent, and then, but of course, 3 is 10% of the ratings, and now 3 is the alert rating for supervisors. What are the main results going back to these research questions? How can we measure examiner discretion? Well, suppose that we define our IJT, the rating by examiner I of bank J at day T. Now, we can try to predict this rating by using observable characteristics that I think should be dated T minus 1. And then we can define the directional discretion as the error in this prediction, the rating minus the prediction of the rating. Now, absolute discretion would be just the absolute value of the directional discretion. Now, these measures can be aggregated at examiner level, so we can see that whether a particular lead examiner has high or low directional discretion. Now, this is the distribution of discretion. You can see that is centered at 0, the directional discretion on the left part of this panel. And that one thing that you can notice is that it has large variance here. Okay. What about this discretion matter for exposed bank behavior? We are looking at the error term of this prediction. And what they show in the paper, very interesting results, is that higher Tier 1 capital ratio and lower loan growth is associated with this directional discretion. On the ex-ante bank behavior, what they do is they look at examiner uncertainty at the state level, looking at the average of absolute discretion over the last 5 years. And what they show is that this is the anticipatory response. Both proxies lead to higher Tier 1 capital ratio and lower loan growth. So they seem to matter in terms of bank behavior. And finally, in terms of predicting future performance, what they show is that directional discretion leads to higher ratings, which is bad. Remember, 5 is bad. Higher non-performing loan ratios and higher delinquency ratios. So they are informative about so there is value in the soft information, and it has an effect on bank behavior. Now, there are other results which I think are very interesting. The examiner rotation is random, as was presented. If you regress the composite rating on its components, the highest weight is in the management rating, which is, of course, the most subjective component. But let me now, and there are some other results that I think are very interesting. For example, in the smaller sample of concurrent state and federal ratings, the disagreement is common, and this is especially the case in the management rating. Okay, now, I will focus my discussion on 2 parts. First, I want to review the conceptual framework that is in the paper, and then I'll have a few brief comments on the empirical results. On the conceptual framework, I think that they state this as a goal to distinguish between informative variation arising from soft information and unproductive variation arising from noise. Well, I really have a problem here with this statement, because I think that, I mean, I may be wrong, but I think that this is not possible, since soft information is a noisy signal of the safety and soundness of the bank. So the two things go hand in hand. So how do I think that, and also in the conceptual framework in the paper, they make this reference to the unobserved optimal rating decision, but it's not clear to me what you mean by optimal. And then they look at the examiner rating as a random deviation from this decision. So it's not clear to me how is soft information incorporated into this framework. So what I'm going to do is to present you briefly an alternative framework that I think is more suitable to the way in which the empirical results are presented. Now, let us define the Z as being the underlying state of the bank, which is a latent variable. X is going to be the hard information, and S is going to be the soft information. So just for simplicity, assume that after suitable normalization, all these things are normally distributed random variable 0, 1, 0 mean 1 variance, unit variance with the corresponding correlations. Now, bank rating is basically the expected value of the underlying value of the solvency of the bank, conditional on both the hard and the soft. That's what the supervisors do. What we can do as econometricians is to predict bank rating using the X, the observable hard information. And then, of course, you can actually compute by the properties of normal distributions. It will be very similar with linear projections. The R is going to be just a linear combination of the hard and the soft. And the prediction is going to be just, again, a function of the hard information, because that's the only thing that the econometrician observes. Now, from here, you can define directional discretion as the gap between the R and the R hat. This is the error term, which has an absolute discretion, would be the absolute value of these two things. And then note that we have, of course, the expected value of directional discretion is equal to 0, which is what was shown in the previous figure. I think that this kind of framework is very nice because it can incorporate examiners' biases, as noted in the seminal paper by Agarwal, the inconsistent regulators, published in the QJ in 2014. Federal examiners are tougher than state examiners, and then you can add a bias term in the rating, and can be high or low, and then you can show that the expected value of the directional discretion would be lower for one of the two examiners. Okay, so summing up, I think that this alternative setup provides a simpler and better framework for understanding the empirical results in the paper and the role in which soft and hard information are combined into these ratings. Okay, quickly, empirical results. Now, Camel's ratings are discrete. They go from 1 to 5. So the determinants of going from 1 to 2 or 2 to 3 are different. And also going from 2 to 3 to 3 to 2 is obviously something which is very different. So I think that I would argue that it's much better to use discrete choice models throughout the paper. Second comment is that data on directional discretion could be exploited more. I mean, they use, look at the correlation with observables beyond the state and federal. For example, there are different types of federal examiners, the Federal Reserve, FDIC, OCC. You can have other types of observables to see what is behind this directional discretion. Now, there is this claim in the paper that greater directional absolute discretion only adds noise without improving forecast accuracy. I think that this claim should be toned down because the difference in the regression coefficients are only marginally significant. And also, I think because note that noise encourages this prudent bank behavior. So I think that there is this ex-ante benefit of having some sort of noise in terms of and I have a paper on that point. So let me just conclude. I think that the paper addresses a novel issue with an amazing database. There are many interesting results. More work can be done along these lines. I think that more work can be done on bank supervision generally. I think that the intermediate goal for policy would be to improve the design of supervision, but there would be a final goal, of course, to conduct some sort of welfare analysis of bank supervision. And let me just add two minor suggestions. One is for the title of the paper. I think that I would suggest to replace discretion in regulation by discretion in bank supervision. I know in the US the two things are mixed together, but this is the time in which we can start distinguishing between these two terms. And finally is a major suggestion for the ECB, and Claudia is here. So I think that you should start exploiting the SSM data on bank supervision like they've done in the US, and in particular, for example, the effect of the composition of the joint supervisory team. So thank you very much.
A perfect transition to our second discussion, Claudia Buch, please.
Yes, thank you very much, and thanks a lot to Luc and his team for organizing the conference, for giving me the opportunity, and I'm also speaking always, on behalf of the whole team. I will provide you with some actually evidence from our own work to have me here and also contribute a bit of a practical supervisory perspective, and I'm particularly grateful from that perspective that you put a question mark to the title, The Next Financial Crisis. So of course, we do everything that we can to keep that probability as low as possible, the impact as small as possible. So actually, I had read the paper before I was actually asked to provide comments here, because I think it is indeed extremely interesting and relevant for our own work. So I fully agree with what Rafael said, that we need to do more work on assessing supervisory effectiveness. So what I would like to do here is just, I mean, my summary slide is just one page, so I will be very quick, but then also explain a bit what we currently do in the SSM, concretely on assessing supervisory judgment, but also more broadly, I think what's important is that judgment is not just replacing rule-based decision-making. It also requires, time for the supervisors to look at new trends, forward-looking assessments. So we also do a lot to streamline our procedures precisely to give that time and space. But just a quick summary of the results of the paper. So yes, supervisors apply judgment, and as we've seen, the ratings reflect discretionary assessments. Judgment has real effects. We've seen the effects on capital and lending. I'll comment on that later on. And then judgment improves predictive power. So there's always this balance to strike. So how rule-based do we want to be, then ignoring potentially interesting forward-looking information? But of course, judgment can introduce noise, has been discussed. So we need to find a way to balance these two elements and make the best out of the rule-based component, the judgment component. I think the paper makes a very important contribution to this literature by providing us with a framework how judgment can be assessed, and we should do more of this work. And I felt a little bit reassured in how we're using judgment in the SSM, because we use constrained judgment. I think it's exactly what also this paper is arguing for. So this is a little bit small print, but just to say that we also have a scoring system in the SSM, the so-called SREP scores. And if you just want to focus on the second line from the bottom, it's basically 4 elements that enter. That's business model, the governance of the banks. As we know, this is crucially important, in particular in a very uncertain environment where we just need, good judgment, good management of risks, and that requires good governance. And then, of course, we look at risks to capital, and also we assess liquidity risks. So all this goes into a scoring system. I won't go into the very detail. Perhaps a little bit different from the US, this also has implications then for quantitative capital requirements, so the Pillar 2 capital requirements. There's not a one-to-one translation from the scores to the capital requirements or qualitative requirements, but this is an important basis. In our case, the range is from 1 to 4, and for the grades 2 and 3, we also have qualifiers. But as I said, what's important here, we really have 3 phases of the SREP, so the supervisory review and evaluation process of that assessment, which is basically what I said earlier, a process of constrained judgment. So the supervisors start with collecting lots of information, including from banks' own internal risk assessment systems. So this is the data gathering phase. Then there's an automatic score being calculated, but then in the third phase, supervisory judgment comes in. We're currently reforming the P2R methodology, so how do we come up then with the capital requirements? And there's I will show you later on, there's 2 elements where judgment comes in for the overall score and also for the individual elements. But this is, the judgment part is already in the current framework. So my comments, not sure whether this is the title is a bit broad, what determines the choice between rules and discretion, but the 2 points I would like to make here, and I think also that's where the paper maybe could go into some more detail, because you have a really nice data set, not just in terms of the granularity, but also of the time period covered. I think it's 98 through 2020, so you have a lot of structural change, regulatory changes in this period. It would be interesting to see whether the results would differ if you would run the regressions over different subsamples. So why do I think this is important? Well, in particular, at the current juncture, we have a lot of uncertainty. Geopolitical risk is one element, actually one priority for the SSM. We have lots of structural breaks. Just to give you one example, we had major shocks hitting our economies, COVID, the energy crisis. large parts of these shocks have been buffered by other policy areas, fiscal policy first and foremost. So actually the real effects of these shocks have not really hit banks' balance sheets, which is of course good news, but this is something we need to take into account when we do a forward-looking risk assessment and also, in that sense, scoring of the banks. So what I'm saying here is that, of course, the rule-based component of whatever we do is becoming less and less reliable in an environment with uncertainty and structural change. And it would be interesting if the authors could explore this a bit more, whether their results have anything to say to this debate. And then, and I think it was interesting, you kind of mentioned this in passing, so how transparent do we want to be as supervisors about the methodologies we use? And there was a dedicated strategy in the SSM to increase transparency, to publish what we do. There's lots of guidelines around it, but of course we can't publish, or we can't really, there's no quantifiable effect of the discretionary component. We can say where discretion comes in, but this is not something we can publish. So I think it would also be interesting if the paper could inform that debate a bit. Second point, and this actually goes to what Rafael said, how to evaluate the effectiveness of supervision. And I think the paper provides a great empirical framework for doing this. So what is the intended, what are the unintended effects of judgment? And we have done some work, or I should actually be more precise. So these are the colleagues Gabriel Borbecha and Silvio Plica, who have done work with our SREP scoring, also showing how judgment is used currently. And as in the US, yes, the supervisors adjust the scores to stabilize the outcome, so they don't just use the automatic score. And they take into account the macro environment. They also take into account the supervisory priorities that we are setting in a very structured way. So this is reflected in the scores. I think we don't just need an empirical framework to identify all these things, but I think, and this is where also Rafael's work is so important, we also need a theoretical framework. How do we want to assess, whether the judgment that is being used, whether this is positive or negative in terms of the welfare implications? So the paper finds that discretion makes banks more conservative, which would enhance resilience. So is it, I would tend to say, and this was also mentioned as a supervisor, this is a positive outcome, but of course we need to assess this, and we need to continuously also work on understanding the use of judgment, and we need to use the framework that has been presented here. Then my final comment is on how to specifically exercise judgment. So judgment is a very, general term, and there's a few things that the paper suggests how judgment can be used without introducing judgmental bias. So these are guidelines. As I said, we are using those moderate constraints to preserve flexibility but still enhance consistency, and maybe even algorithmic tools can support rather than replace supervisory judgment. So as I mentioned earlier, this is even more difficult to read than the previous slide, but all this will be published so you can look at it. We do have a new methodology for the P2R, which introduces two elements for judgment in this here on the right-hand side. It's simpler than the current one, and it has two elements for judgment in step 2 for the individual scores and for the holistic adjustment. All of this is being benchmarked within the SSM, so we do a lot of work to make sure that also the scoring and all this is used consistently. So to conclude, supervisory judgment is essential. As I said, this is not replacing rules and analytics, but really trying to make sure that also forward-looking information is integrated into what we are doing. Both qualitative and quantitative aspects are important. Generally, in our supervisory judgment, we need strong governance, we need strong financial and operational resilience. And I think judgment is particularly important to also adapt to the changing risk environment. So this is what we're doing with a much broader set of reforms of the SREP to really make sure that supervisors have the space, the capability also to use analytical tools to exercise this judgment in a useful way. And finally, but this holds for the whole, we have a big debate about regulation and supervision. I think we really need to be careful to take conclusions from that debate. We need to evaluate, we need sound rigor analysis, but this is exactly what this paper is about. So thanks a lot again for having me here and allowing me to discuss this paper. Thank you.
Kelly, would you like to take a couple of minutes and address some of the comments?
Sure. Well, thank you very much to both my discussants for the extremely helpful suggestions and comments. All of what you said is very well taken. Let me start with Rafael's comments. So first, thank you for the specific econometric suggestions. We'll definitely take into account, use more discrete choice models, et cetera. Thank you also for proposing this kind of alternative modeling framework. We'll consider that very carefully. I just need some time to absorb it, but I think kind of using this correlational matrix structure could be very useful. Just in terms of what is soft information, can that be represented by a variable given that it's open to interpretation? I think what we have in mind, this might also be in your model, is we think of soft information as a true measure of bank quality that is attached to a case rather than to a decision maker. So soft information is a latent variable that exists. However, for us to be able to access it, each of us seeing that soft information will see S plus our own individual error terms. That's kind of what we have in mind when we think of soft information. And actually, both discussants had talked about, can we reduce noise? And then importantly, Rafael pointed out, do we want to reduce noise? Because he has a model which I find very intuitive, which is the more noise you have, you actually can lead to more conservative bank actions, which is perhaps what we want as supervisors or as part of the bank regulation system. It just is a open question how much noise then we want, because this is a type of noise that I mentioned earlier is quite difficult to control, unlike an opaque stress test, okay? Because neither side knows exactly where this noise is going to lead. And further, this is a type of noise that ex post, we have banks in terms of their lending and capitalization just bouncing around each year because of which new examiner is assigned. So there are costs of this noise. It just needs to be balanced with perhaps the benefit of noise in terms of leading to conservative actions. Claudia also asked about what more we could do in the data. We'll do more of those tests. But one thing that we did look at in terms of, we have a long sample period, is we look at before and after the great financial crisis. And what we find is after the financial crisis, if anything, discretion slightly increased, and also the weight on this most discretionary component, which is management quality, has further increased as well. So this is if anything, trending up. Okay.
We take some questions from the floor. Luc, here in the front.
Luc Laven, ECB. I wanted to ask about what you call noisy supervisors. So are these truly randomly distributed across the population? Or, which I think you hinted at, you basically end up, this noise comes from you have a bunch of tough supervisors and you have the softies out there. If it's the latter, I think most of us would agree that the problem that we have faced with supervision over the years is that there are too many softies out there. And so maybe then the way you set this up in this more symmetric fashion would need to be rethought a little bit. I just wanted to have your sense on that. Now, in terms of getting to the solutions, which is the most important aspect, of course, that also Claudia asked about. I mean, at least in most other similar settings, unlike the one, the Kahneman setting where you seem to know it's the 5 years, right? But in most cases, let's say you remember from your school exams or something like that, you have an oral exam, you have two examiners, one after the other, they seem to disagree, you could contest. So is there any, at least discussion in the US around that? I mean, especially if fundamentals haven't changed and from one day to the next your rating suddenly changes, can this be challenged? That would be an easy solution, at least, in addition to just fixing the weights to 20%.
I see. Let me take the first part of your question, which is what accounts for a lot of this variation. A big part of it is just examiner fixed effects. So that would be, some people are just predictably more tough than others. When we look at our second measure, which is absolute discretion, so that's among people who are equally tough on average, we still do find substantial variation in some people, are just more difficult to predict based on the hard information in either direction. I think that second component is approximately equal in magnitude. So they're both there. It's kind of like, in the academia, we have tough referees, lenient referees, and then there's some people who aren't particularly tough or lenient. They're just hard to predict. With respect to your second question, that's very interesting. I am not an expert on kind of how successful kind of pushing back on a rating is. Does anyone in this room know whether it is possible to contest these ratings? Yeah.
I don't have the answer for the US. I mean, of course, in Europe, we also generally, about all our supervisory decisions, there's a right to be heard process. Internally, there's a benchmarking process. So I don't know, we have a second line of defense, which is doing that benchmarking. So, but that would rather be a question to you whether that's the same in the US. I'm not an expert on the details there.
I will check with perhaps our Fed co-author, but I think, Ahmed just says no. So there's one answer. The other thing is, I believe we're looking at the rating, whatever was finalized after possible back and forth. So even in that final rating, we're finding this kind of strong, at least examiner fixed effect and absolute discretion in these ratings.
Levine, Hoover. So I think it's a wonderful paper. I've seen it presented a couple of times. It's excellent analysis on an under-examined area in finance. And my question is not about the research per se. It's about, it's just a difficult to understand evaluation of how can the US supervisory system be this way for so long. And let me give you a sarcastic story. Let's say you have a bank examiner in the US, goes to a bank. And what the bank says is, here's how we evaluate our loans. We randomly choose a loan officer. They go to the firm, they evaluate the loan, they give us a number, and then we decide. Okay? The bank examiner would almost certainly say that's bad management, because what would typically happen, you'd expect in a bank, is that the bank would have examiners that are very close to the bank that obtain the soft information that comes from these ongoing relationships. Then this type of information would come back to a review process within the context of the bank. They would review this as a way to sort of sort out the random component that would come from individual bank examiners, and in that way try to distill the really good part of the soft information, combine that with the hard information, and then come up with an evaluation of whether to make a loan. And so it's hard to understand how an entity that would expect that of banks wouldn't expect that of itself. And I'm wondering, given your interactions with the Fed, is there any assessment? Now, the one argument, and this could be, is that it never dawned on them, and your paper is sort of a way of illuminating this shortcoming in how they're doing evaluations.
I mean, it's a great question how this can be allowed to take place. I will say, I think our paper matters for bank supervision, but it has broader kind of implications. So there's parallel work on judges. And in terms of the variation in judge fixed effects, it's terrifyingly large. Some judges grant parole at 80% rate, other judges grant parole at a 20% rate, random assignment to the same set of cases. So this type of dispersion is not unusual. Like, the reason why we can look at bankruptcy outcomes is the judge fixed effect in terms of who favors Chapter 7 versus 11 or 13 is also huge, okay? Which again, great for empiricists, bad that these outcomes are so randomly assigned to cases. Not specific to banking, but I think part of why this could be allowed to occur is there is a sense of overconfidence among professionals in which, like, I may not want all of you to have discretion, but I want to maintain my own discretion. And what we do find in our sample is that the amount of discretion that these examiners exercise actually slightly increases with their experience. So it's kind of, they have more confidence in their personal judgments as being kind of more relevant than the hard information.
Jean-Charles?
Thank you very much. Rocher, Toulouse School of Economics. So it's a fantastic paper, I enjoyed very much, and I think your setup is adapted to study several possible extensions. So let me give you 4 quick comments or suggestions. One is committees. What would happen if the decisions were made by several people instead of one? Would this reduce the noise? Second, complexity. There is a lot of discussion about the excessive complexity of bank regulation and ideas to simplify it. So suppose in your model you reduce the number of criteria. Would this lead to more or less biases? Third, incentives for supervisors. Supervisors do not always do what they think is best for society, but what is best for their own careers. And so the idea of having a long-term relationship between a supervisor and banks is not necessarily good in terms of possible collusion. So I believe that if you introduce, in particular, if you evaluate the performance of supervisor, is it something that is done in the US? I think it would to change the incentives of supervisors. And finally, there is a literature, an old literature on bank bailouts, the notion of constructive ambiguity. This idea, which I don't like at all, that if you decide randomly whether or not you will bail out the banks, this would increase the incentives of bankers to behave. Would you have something like that here, in the sense that discretion can improve the incentives of bankers not to take too much risk?
Thank you. I've taken notes. Those are 4 great suggestions. Thank you.
I'll take 2 more questions. Paula here.
Paula Sapienza Hoover. I love the paper, but I actually wonder, besides the effect, the fixed effect at the level of the individual examiner, whether there are also bilateral biases, which I think it would be actually very interesting to study within the the ECB, given that you have these multiple countries. There is strong evidence that even within multinational banks, the way in the European setting, the way they evaluate the bond allocation by countries in different countries is presenting bilateral biases. And so in some way, I don't know what other variable you have about the specific, in going back to Kelly, in this setting, like to what extent, you come from a different areas and, there are differences on the identity of the people and so on. But in the European setting, I think this would be very powerful. I assume that, and there was some discussion early on about how you form those teams and how much people come from different countries and so on. And I think that would be a fascinating topic.
I think it's a question to both Kelly and Claudia, so maybe you can take turns.
Just briefly. Oops. Yeah. Just briefly, because also the point of incentives was being mentioned. So this is why we have, first of all, the benchmarking in place, where an independent unit within the SSM looks at all the decisions being taken, benchmarks, discusses with the teams, and that is I think very powerful. In terms of the nationality component, so the joint supervisory teams, first of all, we also have a rotation so that you can only be in that team depending on whether you're member of the team lead for a certain period of time, and the team lead can never be from the same country as the bank. So we do have the ECB that's in the lead, and we have the national competent authorities in there, but it's important that the team lead is always from a different country. So these are mechanisms to also deal with potential incentive issues. Yeah.
Okay. Yeah, I think bilateral matching could really matter. I think it's generally been shown in hiring or among loan officers that if there's greater similarity between the decision maker and the candidate, you can extract kind of more precise information, which also means that if you're, let's say, a case or candidate from a smaller demographic group, then you're less likely to be matched to a decision maker who can extract your soft information. And that can put you, depending on the context, at an advantage or a disadvantage. Yeah. So it can definitely matter.
A last short question from Emil.
Thanks, Emil Werner, MIT. It's a fantastic paper. I wanted to get your thoughts on the striking result you find on the role of management. There's actually kind of a lot of discussion now about whether maybe management should be, play less role in the CAMELS rating. Some people argue that it should be removed. But if you look at, there's been, over the past 100 years, the OCC, the Fed have done a range of evaluations of why banks fail. And very often, like the OCC, for example, in one report says 90% of bank failures are due to kind of fundamental management issues. That's sort of the root cause. Now, one story might be that humans just love to blame other humans, and so maybe that's kind of an ex post rationalization. But another view is that maybe this management component is actually very important for understanding the risk of bank failures, but it also just happens to be the one that's really the most difficult to judge and the most subjective. And so I wonder, kind of in your framework, how do you think about that trade-off? That maybe it's a variable that matters a lot, but the most difficult one to assess.
I don't think we don't find significant differences, which is not to say that management isn't very important, but basically the discretionary component of the management rating doesn't seem to predict future measures of bank health more so than the other measures. Okay? So we don't find strong evidence that management matters more than, let's say, capital adequacy or the quality of assets, et cetera. But it certainly could matter more for the failures. We don't have enough of a sample to really study that. So yeah, I don't think we get to conclude from our research that it is a mistake to put so much weight on management quality. I mean, that could really be a determinant of bank failures, but it certainly leads to a lot of disagreement.